As globalization deepens and political tensions rise, geopolitical risks have become an unavoidable part of investing. In 2025, investors must be more aware than ever of how international conflicts, policy changes, and diplomatic events can influence financial markets. Whether it's trade wars, elections, military conflicts, or shifting alliances, these risks can cause market volatility, impact specific industries, and even trigger broader economic downturns. Understanding geopolitical risks doesn't mean avoiding investing altogether, it means being better prepared. This video highlights the top 10 things investors should know about navigating geopolitical risks in 2025 to protect and potentially grow their portfolios. 1. Geopolitical risks are increasing in complexity. In 2025, geopolitical risks are more interconnected and complex than ever before. Issues like cyber warfare, supply chain disruptions, energy politics, and the weaponization of trade policies overlap, making it harder to isolate a single factor that could impact markets. Investors need to think beyond traditional military conflicts and recognize that non-traditional risks, such as cyber attacks on financial institutions, can have massive economic consequences. A broad, global perspective is necessary to anticipate where the next risk might come from. 2. Emerging markets are especially sensitive. Emerging markets can offer higher returns, but they are also particularly vulnerable to geopolitical instability. Countries with fragile political systems, dependence on foreign investment, or unstable currencies are often hit hardest during times of global tension. In 2025, investors should be cautious when allocating large portions of their portfolio to emerging markets without proper risk mitigation strategies. Diversification, hedging, and careful country-specific analysis are critical when investing in these regions. 3. Elections around the world can move markets. Major elections in the United States, European Union, India, and other key regions in 2025 will likely cause heightened volatility. Election outcomes can dramatically shift economic policies, including regulations, taxation, and trade agreements, which in turn can influence specific sectors and overall market performance. Investors should monitor political calendars, assess how different candidates' policies could affect industries, and be prepared for potential market overreactions both before and after election results. 4. Energy markets remain highly geopolitical. Oil, natural gas, and renewable energy markets are heavily influenced by geopolitical developments. Conflicts in the Middle East, sanctions on energy exporters like Russia, and global efforts to combat climate change all have direct impacts on energy prices and energy companies' profitability. In 2025, the transition to green energy will add another layer of political complexity. Investors should keep a close watch on energy policy changes and consider how shifts in energy supply chains could affect their portfolios. 5. Trade wars are evolving, not disappearing. Although the rhetoric around trade wars may have cooled compared to previous years, underlying tensions persist. Trade disputes between major economies like the US, China, and the EU are shifting toward technology, data security, and green industries. These conflicts can lead to tariffs, import restrictions, and retaliatory measures that disrupt global supply chains. Investors should analyze companies' supply chain resilience and exposure to international trade when making investment decisions in 2025. 6. Currency volatility is a hidden risk. Geopolitical events often cause rapid fluctuations in currency values, impacting everything from multinational corporations' earnings to the price of imported goods. For example, a political crisis in a major economy can cause its currency to plummet, affecting global investments tied to that market. In 2025, currency risk will be an important consideration for investors involved in international markets. Strategies like investing in currency-hedged ETFs or diversifying across multiple currencies can help manage this risk. 7. Defense and cybersecurity sectors could benefit. Not all geopolitical risks spell doom for investors. Some sectors, particularly defense contractors and cybersecurity companies, tend to perform well when tensions rise. Governments worldwide are increasing defense budgets and investing in cyber defense to protect against threats. In 2025, companies specializing in cybersecurity, aerospace, and military technology could offer attractive growth opportunities for investors seeking to capitalize on rising global insecurity. 8. Diversification is your best defense. One of the most effective ways to manage geopolitical risk is through diversification, across asset classes, sectors, and geographic regions. Concentrated bets on a single country, sector, or asset class increase vulnerability to political shocks. A well-diversified portfolio can help absorb unexpected events without catastrophic losses. In 2025, global diversification strategies will be even more crucial as different regions face varying levels of risk and opportunity. 9. Safe haven assets gain appeal during uncertainty. During periods of heightened geopolitical tension, investors typically flock to safe haven assets such as gold, U.S. Treasuries, the Swiss franc, and the Japanese yen. These assets tend to hold or increase their value when markets become volatile. In 2025, keeping a portion of your portfolio in safe haven assets can provide stability and serve as a counterbalance to riskier investments, especially during sudden geopolitical crises. 10. Staying informed is essential. Perhaps the most important thing investors should know is the necessity of staying informed. Geopolitical risks evolve rapidly, and being caught off guard can be costly. Following reputable news sources, consulting geopolitical analysts, and staying updated on international developments can help investors anticipate risks and respond proactively. In 2025, using technology like real-time news alerts and specialized financial platforms that track geopolitical risks will give investors an edge in adapting to changing conditions. Geopolitical risks are an inevitable part of investing, and in 2025, they are more intricate and influential than ever. Understanding these risks, whether they stem from elections, energy disputes, cyber threats, or trade conflicts, can help investors protect their portfolios and identify new opportunities. By diversifying holdings, investing in resilient sectors, managing currency risk, and staying informed about global developments, investors can navigate the uncertainties of the international landscape with greater confidence. While it's impossible to eliminate all risks, smart preparation and strategic thinking can turn potential threats into opportunities for long-term success.